Welcome to the Pro Ticker Deep Dive. So, if you spent any time at all looking at financial markets in 2023 and into the first half of 2024, there was just one phrase you could not escape.
Oh, I know the one.
It was everywhere. In every trading room, on every news network, it really became the undisputed consensus trade of the era,
Right.
higher for longer.
Yeah, and that phrase, it was more than just some macro forecast. It was basically a specific instruction for how to trade bonds.
Right.
The core belief was that this persistently sticky inflation, combined with a uniquely resilient labor market, would essentially chain the Federal Reserve to these elevated interest rates.
The 5.25 to 5.5%
It's
range.
well into 2025.
And the trade that came out of that belief was, it was incredibly powerful. It told investors, get out of long duration bonds, which are super sensitive to high rates, right? Instead, just stack cash and short-term stuff like T-bills, which were yielding a fantastic 5% or more. It felt like the perfect low-risk, high-return strategy.
For a long time, it felt bulletproof.
Yeah.
But as we're looking back now on late 2024 and early 2025, we're seeing this spectacular, almost violent unwinding of that whole consensus.
Yeah.
So today, our mission is really to unpack precisely why this seemingly unassailable trade cracked. And more importantly, what it means for those investors who got caught betting wrong, not really on the level of rates, but critically on the timing. The timing and the path of normalization.
That's the key.
That's the key. The insight you should hold on to throughout this dive is that higher for longer was ultimately a crowded trade. And like all crowded trades, its greatest risk was its own internal vulnerability.
Okay, so to really understand let's call it the trauma of the unwinding, we have to appreciate the environment that made the consensus so strong in the first place. Let's rewind a beat.
We have to. The setup was this. The Fed had just finished its most aggressive hiking cycle in decades. Rates shot up from, basically 0 to over 5% between March 2022 and July 2023.
An incredible shock to the system.
A huge shock. And historically, that kind of rate shock is supposed to guarantee a recession. Conventional economic models, they all said 5% rates would choke off demand, spike unemployment, and crush inflation.
But the U.S. economy was just frustratingly resilient.
Persistently resilient.
And that resilience was the fuel for the whole thesis, wasn't it? Where did that unexpected strength even come from?
Well, we saw a few factors really defying gravity. First, consumer spending stayed remarkably robust. It was propped up by strong wage growth and what the sources call this huge overhang of excess pandemic savings.
Right, people just had more cash than anyone expected.
They did. And second, corporate earnings were holding up much better than forecasts, which meant companies weren't shedding jobs aggressively. So the labor market stayed incredibly tight.
And then there's the whole reason for this mess inflation. It just refused to fully cooperate.
It got stuck. It came down from the peaks of 9%, sure, but it got really, really stuck.
Yeah.
So while the headline CPI improved, core inflation, the one the Fed really watches, it just hovered stubbornly between 3.5% and 4%, all through 2023 and 2024.
And the problem child there was services inflation, right?
Absolutely. Driven by high rents, sticky housing costs, and wage increases filtering through that whole labor-intensive service sector. And since the Fed targets the PCE measure, which is a little different, that stickiness was particularly worrying for them.
And the Fed itself, led by Jerome Powell, did a masterful job of shaping the narrative to match this reality. They weren't even talking about cutting rates.
Oh, not at all. They were talking about patience.
Yeah.
They absolutely dominated the messaging. Powell's speeches, especially in the fall of 2023, were explicit. They were tamping down any and all expectations of a pivot. The Fed was jawboning the market, telling everyone high rates were the new normal.
And by early 2024, their own forecast, the dot plot, backed that up.
It did. It projected only 3 rate cuts for the entire year. That signals a slow, painful normalization, and it just cemented the intellectual foundation of higher for longer.
And it wasn't just talk. The actual plumbing of the bond market also seemed to agree. We had these structural forces pushing long-term yields higher.
We did. It's a classic supply and demand issue. On the supply side, the U.S. Treasury was just issuing a dramatic amount of new debt.
Right.
And at the same time, 2 of the biggest buyers were missing. The Fed wasn't buying. Quantitative easing was paused, and foreign central banks were actually reducing their allocations.
So more supply, less demand.
More supply, less institutional demand. That drives up the term premium, which is just the extra compensation you demand for locking up your money for 10 or 30 years. This whole cocktail resilience, sticky inflation, hawkish talk, and supply, it made betting against long bonds feel like the only rational choice.
So if you're a trader in mid-2024, The logic is it's undeniable. It's
Yep.
almost mathematical. Why would I buy a 10-year treasury with all that duration risk and lock in a 4.2% yield
Right.
when I could just sit safely in a 3-month T-bill and earn 5.3%? You get higher income and you have total flexibility.
And for the first 6 months of 2024, man, if you were in that trade, you were getting paid. The 10-year yield actually climbed higher, hitting 4.4% by early June. The trade was being validated in real time.
But trades that get too crowded, they become fragile. So where did the first crack appear in this consensus?
It wasn't a sudden event. It was more of a slow bleed of economic data throughout the late summer. We started seeing these consistent signs of cooling.
Okay.
Slower job creation, a slight but measurable uptick in unemployment, and I think crucially, the realization that those excess pandemic savings were finally starting to run out.
And inflation.
The Fed's preferred gauge, the PCE, started trending much more decisively toward that 2% target. The market's worry was shifting, from a reacceleration of inflation to maybe slowing growth.
And this softening, it set the stage for the real turning point, that critical pivot in September 2024. So what was the market expecting, and what did the Fed actually do?
Well, the market was positioned for continued patience, maybe a token 25 basis point cut,
Yeah.
a cautious little adjustment,
A small
a very small step. Instead, the Fed delivered a surprise 50 basis point cut. It doubled the expectation and signaled a real willingness to move quickly.
Wow.
And that single action, it didn't just move the federal funds rate. It just blew up the entire psychological foundation of the higher for longer trade. It showed the Fed was prioritizing action over its old hawkish rhetoric.
That's fascinating. It's like the captain was still yelling full steam ahead, but then just suddenly spun the wheel 90 degrees. And for bond investors, the technical signal that confirmed this shift was the yield curve itself.
Absolutely. The yield curve, specifically that 210 spread, had been deeply inverted for over a year.
Which means short-term yields were way higher than long-term yields.
Exactly. The classic, most reliable recession warning sign. And once the Fed cut in September, that spread finally began to normalize. It began to uninvert.
Okay, walk us through what that normalization actually means, because this seems to be where the core trade really went wrong.
Okay, so when the curve is deeply inverted, investors believe the Fed has to keep rates high now, but will be forced to slash them later because a recession is coming.
Got it. High short-end yields, low long-end yields.
Right. But when that spread starts normalizing, it signals one of two things. Either the recession threat is fading, or the Fed has officially started a cutting cycle that's going to bring those short rates down fast.
And either way.
Either scenario makes long bonds, which everyone had been treating like toxic waste, suddenly look like a very attractive place for capital gains. Those who were just focused on the absolute level of the 10-year yield at 4.3% completely missed the much more important structural shift that was happening in the curves.
Which leads us to the ultimate paradox and what happened in December 2024. So the Fed delivers its third straight rate cut.
Yep.
You would think that signals higher for longer is officially dead, but the twist was in the new messaging.
Precisely. We got the cut, which confirmed the direction of travel, but the new dot plot signaled a major reduction in the expected pace going forward. It projected only 2 cuts in all of 2025.
So a hawkish surprise.
By definition, a hawkish surprise.
Yeah.
And based on pure fundamental analysis, that surprise should have caused long-end yields to rise.
Okay, hold on. So the Fed said they'd cut fewer times next year, but the 10-year Treasury didn't rise. It collapsed.
It collapsed.
From a high near 4.39% in December down to 4.09 by early 2025. That's a huge move.
Triggering massive capital gains for long bondholders.
So how does that math even work? Why did the market just completely defy the Fed's own forward guidance?
This is the most crucial part of this whole deep dive. The reason for the yield collapse was almost entirely driven by market structure and flow dynamics, not the underlying fundamentals or what the Fed was saying.
What do you mean by that?
I mean, once the cutting cycle officially starts, regardless of the Fed's stated pace, it triggers these enormous institutional allocation shifts.
Can you break down those flows for us? Who are these big players and why did they suddenly have to buy duration?
We're talking about entities that have multi-year liability matching needs. Think pension funds, insurance companies, sovereign wealth funds. These groups had been purposefully underweight duration during that whole high rate period.
Meaning they were exposed to rates rising because they expected to earn more on cash.
Exactly. But the moment the Fed confirms a cutting cycle, that entire risk calculus flips. Their mandates require them to lock in a return when rates are falling to match their long-term payouts.
So once the music stopped, once the Fed cut 3 times, it triggered this mandatory non-discretionary buying spree from these massive funds.
It was a stampede for the exits of the cash and short-term trade. The crowded nature of higher for longer meant that when the tide turned, everyone tried to exit through the same small door at once.
And that led to mass capitulation.
Mass capitulation. The investors sitting on 5% plus yields suddenly face huge losses on that position relative to the capital gains in long bonds.
And we can see this so clearly in the technical data. Through September 2024, the 10-year yield fiercely defended that range between 4.15 and 4.35%. That was the consensus holding the line.
That 4.2% level was the technical floor of the entire trade. And the decisive break came in December, when those flow dynamics just overwhelmed the fundamentals. Once yields broke below 4.2, the downtrend was on,
leading to that huge drop in just a couple of weeks.
A move triggered by flow and capitulation. It confirmed the death of the old thesis.
And looking at the 2-10 spread, the picture is just undeniable. We went from a deep inversion, a recession signal, of negative 80 basis points in early 2024 to a modestly positive spread of over 55 basis points by late 2025.
The whole structure has flipped. And that means the market is no longer rewarding defensive short-term positioning. It's now rewarding those willing to take on duration risk.
So let's look at the consequences of this massive reversal. Who got it right and who was caught in that capitulation?
Well, on the winning side, the math is simple. Investors who held long-duration bonds, those who were brave enough to actually buy duration in late 2024, and anyone who avoided that psychological cash addiction trap.
Right.
They earned capital gains that just dwarfed the high income from T-bills.
And the losers, this is where the real pain was concentrated, wasn't it?
Oh, yeah. Significant losses were taken by those who stuck rigidly to the consensus, convinced that 5% cash yields would last forever. This includes managers who stayed overweight short duration and, importantly, real estate investors and businesses who were betting on rates staying permanently high. They got a double whammy. They watched their refinancing costs stay stubbornly elevated while they completely missed out on the bond rally. They were just plain wrong about the timing of the cycle shift.
So the key lesson here isn't really about inflation forecasting, is it? It's about market psychology and dynamics. What was the fundamental mistake that the higher for longer believers made?
There were two. The first, and I think the most avoidable mistake, was confusing Fed talk with Fed action. The Fed will always maintain a hawkish veneer to manage inflation expectations, even when they're ready to pivot. Clinging to Powell's hawkish guidance from a year earlier when the action was a 50 basis point cut was just a failure to adapt.
And the second mistake?
The second, deeper mistake was ignoring the immense power of flow dynamics. In a crowded trade, the marginal move by institutional players matters far more than incremental changes in inflation data. The market repositioning itself is what created the rally, not the fundamental economic data.
Okay, so looking ahead to 2026, the outlook isn't exactly stable. Our sources point to two major competing tail risks that could either bring back a new higher for longer trade or accelerate the rally we just saw.
Right. Risk one is the inflationary reversal. Imagine inflation reaccelerates out of nowhere, maybe because of new trade tariffs or geopolitical event that messes with supply chains. If that happens, the Fed would be forced to pause or even reverse its cuts.
Which would punish long bonds and resurrect a new version of higher for longer.
Exactly. And the opposing risk is the recession accelerator. What if growth concerns really deepen? The source mentions that downside jobs report surprise from December 2024. If we see more data like that, the Fed accelerates cuts dramatically,
turning long bonds into a safe haven asset and driving yields way below 4%.
Right. But the current base case, for now, avoids those extremes for early 2025. It's moderate growth, sticky but slowly declining inflation, and a cautious Fed that keeps that 10-year yield in a stable 4 to 4.1% range. For now, the phrase higher for longer has gone from a strategy to a toxic warning label against herd mentality.
The ultimate synthesis here seems to be that consensus trades, no matter how intellectually coherent they seem, are just inherently crowded. And because of that, they're profoundly vulnerable to unexpected policy shifts and these mechanical flows.
The lesson is always to be skeptical of extrapolating current conditions out into infinity.
And we have to end on the incredible irony of this whole period.
We do. Objectively speaking, a 4% 10-year yield is significantly higher for longer compared to the sub 2% average of the entire 2010 to 2020 decade.
Yeah, that's true.
But the trade defined higher for longer as requiring flat or rising yields and a short duration position. And that definition, that specific bet, turned out to be catastrophically wrong.
See you all in the next Pro Ticker Deep Dive.